Welcome to the show, everybody. I'm Simon Carve, here with Lachlan Reed. And Lachlan, I watched that welcome video we put out, and it got me thinking about how we treat taxes. For most people, tax season is like going to the dentist. You avoid it until you're in absolute pain. But what if we flipped that? What if mastering your taxes is actually the ultimate Wealthbrain move?
Spot on, Simon. If you're treating taxes like a chore, you're basically leaving free money on the table. And the absolute quickest way to flush that money down the drain is what I call co-mingling. It's when you run your business out of your personal bank account. You buy a coffee, then you buy a printer cartridge, then you buy groceries, all on the same card. It's a dog's breakfast, mate.
It really is. I remember a friend of mine, she ran a boutique design agency, and she did exactly that for her first year. When tax time came, she spent 3 entire weekends crying over bank statements, trying to remember if a $50 dinner from 9 months ago was with a client or her mother. It's not just stressful. It completely ruins your compliance, because tax authorities will look at that mess and just disallow your deductions.
And when they disallow those deductions, you're not just losing the basic stuff. You're completely blinding yourself to the massive, high-value incentives local governments put out to actually help you. Take South Africa, for example. SARS offers a massive 150% research and development tax deduction. That means if you spend 100,000 Rand on eligible R&D, you get to deduct 150,000 Rand from your taxable income. But you can't claim that if your R&D expenses are mixed in with your Friday night takeout.
150%. That is a massive multiplier. And it's not just South Africa. If you look at special economic zones across the continent, or the SME exemptions offered by the Kenya Revenue Authority, or Nigeria's Federal Inland Revenue Service, there are incredible breaks built specifically to help young businesses scale. But to unlock those doors, you need a key. And that key is clean books. Which brings us to my absolute favorite rule of thumb. The 90 seconds versus 90 hours rule.
90 seconds versus 90 hours. I love the sound of that, but break it down for us. What's the actual math there?
It's incredibly simple. Every time you get a receipt, an invoice, or a payment confirmation, you spend exactly 90 seconds filing it properly. Scan it, label it, drop it in a dedicated folder. If you do that in the moment, it takes 90 seconds. If you don't, and you get flagged for an audit, you will spend 90 hours of absolute heart-stopping panic digging through old emails, shoeboxes, and bank statements, trying to prove that expense was real.
90 hours of panic. Man, I've been there with an old trail bike restoration business I ran years ago. I thought I was saving time by just throwing receipts in a drawer. Ended up spending a whole week of my life doing forensic accounting on my own life. Never again. Now I use a simple app, snap a photo of the receipt before I even leave the counter, and job's done. 90 seconds today saves you a week of sleepless nights later.
Exactly. And that leads us to the next big trap: deadlines. People think missing a deadline just means a small slap on the wrist. But the reality of penalty structures from authorities like the KRA in Kenya or FIRS in Nigeria is incredibly brutal. They don't just ask for the tax, they stack interest and compounding penalties on top.
Oh, they'll absolutely take a bite out of you. KRA, for instance, has a 5% penalty on unpaid tax, plus interest compounding every single month. If you're a fast-growing startup, that interest can eat your entire cash flow before you even realize what hit you. You're basically taking out a high-interest loan from the government, except you didn't get to choose the terms.
That's a terrifying way to look at it, but it's completely accurate. A high-interest loan you didn't want. And this gets even more complex when you start thinking about cross-border growth. With the African Continental Free Trade Area, AfCFTA, opening up, the potential to trade across borders is massive. It's incredibly exciting, but it also means you're dealing with multiple tax jurisdictions simultaneously.
Yeah, AfCFTA is a game changer for scale, but you can't just wing it. If you're selling digital services or shipping goods from Lagos to Nairobi, you have to understand withholding taxes, double taxation agreements, and local VAT rules. If you don't plan for this ahead of time, you might find yourself getting taxed on the same revenue in two different countries. That'll kill your margins instantly.
Double taxation is the ultimate growth killer. But here's the shift, the real Wealthbrain mindset. Compliance shouldn't be a defensive shield you use to hide from the taxman. It is an active asset. When your books are clean, when you're structured to take advantage of cross-border treaties, you become incredibly attractive to investors. You're showing them you're a professional outfit that's ready to scale.
Spot on. It's about taking control of the steering wheel instead of waiting to get hit by the bus. So, let's put this to the listeners. What is the one financial habit you are actively working on right now to get your wealth brain in gear? Are you finally separating those bank accounts or committing to that 90-second rule? Drop a comment below and let us know.
I love that. Let's start a conversation down there. Thanks for tuning in, everyone. We'll see you in the next episode.
Catch you later, mates.